We are taking a look at the S&P 500 as we get ready to trade October week 2. Yeah, we're already on October week 2 because Friday was October 1st, and so that makes last week, even though it was all September until we got to Friday, that makes week 1 in terms of options. So we're already on week 2. I want to start off looking at the data calendar. I post this link for you a lot. Hopefully you guys are using it. Forexstreet.com, fxstreet.com. That's the one I like to use. It has this great economic calendar, and it has this nice little stoplight system, or this sort of like a yellow, orange, red bar system down the middle that lets you know how important of a market impact a certain data set might have. I think that's pretty interesting. First thing that caught my eye is that starting on Sunday night, tonight, we have China National Day, Sunday into Monday. And that continues all week long. China does not come back into the fold until Thursday, overnight into Friday. So China's closed all week. The last time China was closed for a couple of days was their fall festival, the fall equinox. I think that was when that was going on, or maybe it was just like the 1st of September or something. That's when this sell-off really kicked into gear. After we hit the all-time high on September 2nd, and then we just kind of rolled over, and it really accelerated during those days when China was closed, almost as if to say that overnight, you have interested parties in China that are supporting U.S. futures, and when they're not there to support us, we really roll down the hill. So let's see if that is the case again. It would be the perfect storm for this week to really put the teeth into this sell-off, get it finished and out of the way, and turn around and begin our rally to end the year. All that performance chasing that we see in the final quarter of the year. Okay, so China's closed on Monday. As far as U.S. data is concerned, I have my chart here set to Central Time, so remember to add an hour to what I'm showing you here. We got U.S. factory orders at 10 o'clock Eastern Time. That's about a medium impact on the market, but still it'll move things on Monday, so keep that in mind. On Tuesday, we start getting into some services PMI data. We had manufacturing PMI data last week. This will be overnight from European countries all around the globe. Not China, though, because China's closed. And then ending with our own in the U.S., we get that double dose. We get the market services PMI data at 9:45, and then at 10 o'clock we'll get the ISM services PMI, and you can see that that's a red bar here. That's a high impact data point. On Wednesday, we have the ADP report, another high impact data set. That is the precursor to Friday's non-farm payrolls report. Okay, so if you see some volatility Tuesday into the close, it's people setting up ahead of this ADP report on Wednesday pre-market. Then on Thursday we have weekly claims, and Friday, of course, we have the non-farm payrolls report at 8:30 Eastern Time pre-market, and you can see that is a red bar event. That is a high market impact, obviously, because that jobs report is going to sort of set the tone for what people think the Fed is going to do in November at their next meeting. They have no meeting this month, but they will be meeting in October. And then that's their last meeting for the year. They don't meet again until January. All right, here's what's going on. This is our intraday chart of the S&P 500. Here was Friday's open to start off the month of October. Tried to open above that 5% mark and up above where the September close was, but we quickly rolled over and sold off down to a fresh new low below the September low to 42.88 and some change, and then managed to rally back nearly 100 points on the day to a high at 43.75, and then falling 20 points off of that to close. So a really volatile day. If you bought the low in the morning and used your 80 handle rule, that dip into the 42.80s, if you bought that, even if you just waited till here at 10 minutes after 10, there was some kind of a breakout that occurred, and maybe this was when that stopgap measure was passed in Congress or something for the debt ceiling, whatever. I don't know. I wasn't really watching the market on Friday. I wound up having to go into work, and I only saw the open, and then I never saw the market really for the rest of the day, maybe until lunchtime. And so something happened here around 10 around 11:10 Eastern time, and that really was the breakout point, and we got us nearly a 100-point rally on the day. However, overnight coming into Friday, overnight ES set a low at 42.60. If we use a 10-point spread, which is about what we're doing right now, sometimes it's more than 10, sometimes it's less than 10, but on average around 10 points, that would take us down to about 42.70 on the S&P 500 to go and resolve that. Can't have futures setting a new low that's like a new monthly and quarterly low and not expect for the parent S&P 500 to come back and resolve that in regular trading hours. So I do believe this level will print in the light of day. It just depends, you know, is it going to happen this week, or is it going to be something that happens, you know, after we've had our Q4 rally and we wind up selling off to end the year and come down here. I don't know. But keep that in mind. So our 6% mark that we've been looking for at 42.75 and then 42.70, just below that are some levels that we got to keep on the radar here. Okay, so that's the intraday chart. Let's take a look at the monthly chart. The monthly chart, we just started a new month. You can see that once we dip below the September low, that starts putting us in a very bad light. Once that happens here, back in September, you can see that we had quite a bit more selling to go once we broke below the previous month's low. So are we going to have 2 red months in a row here for October? Are we going to break down further and get below this September low again? We only dipped our toe below it on Friday and reversed, but it's important to keep an eye on the monthly chart because we are messing around with the previous month's low here. Below the September low is this 10-month simple moving average at 41.76. We've not made contact with that level with any of the SMAs for that matter on the monthly time frame since back here in June of 2020 when we were coming off the COVID low. We haven't put 2 red months together since 2020 as well in September and October. So, you know, that's something to think about here. Are we going to have 2 red months in a row like we did here and then have 2 really strong months of rally for November and December? So keep an eye on the monthly time frame and know that and have marked where that September low is. It's pretty easy at 43.05. Once we break down below the low 4300s, you know, we get into trouble because we're breaking below the previous month's low. All right, here is our quote-unquote simplified daily chart backed out. Here is that big, deep pullback that we had earlier in the year. This was the biggest pullback we've had all year. It happened from mid-February to early March at 6%, and that's why we keep watching that 42.75 level, because that would be a 6% move off of this high that we've made. And our October low only made it to 42.88, and we have that October low on ES that would take us a little bit below 42.75. Another thing that's really not pleasing me about this 42.75 level, besides the fact that ES already broke down below its equivalent, and we'd break below this to settle that score, is that, you know, really it looks to me like this pullback here in July is what we're looking to test more closely. And that would have us all the way down to maybe anywhere from 42.50 on down to the 42.30s to back test this stuff. And the reason why this was an important level, if you recall, as we were getting into April and May, we kept throwing ourselves up against that 42.50 mark and failing and pulling back from it. And this was the 13% mark on the year. For some reason, you could see all this resistance, look above and fail, but finally a breakout over this 13% mark at 42.44 and through the 42.50 level, and you can see the big rally that ensued from there, only to get up here to around mid-July and fall backwards and back test this area one more time. So here we are again. Maybe we got to back test this one more time. And if this area fails to hold from around 42.50 to 42.44, or maybe just a little lower to wherever the July low is, if we don't hold this, then we're falling much further. We're falling down to we could hold that 10-month simple moving average that I just showed you on the previous chart, or we could be just simply looking for a move all the way to the 200-day simple moving average. We haven't been in contact with the 200-day simple moving average since, you know, maybe a year ago. And our 2021 halfway back, just below that at 41.04. So there's really, I'm having less and less faith in the idea that this 42.70 to 75 area means anything. Maybe we got to go all the way to 42.50, maybe even look below 42.50. And if all that doesn't hold, then it's the 200-day simple moving average all the way down here around 41.37 and rising. Okay, let's look at the roadmap. The roadmap kind of will show us, what we need to be looking for and how to trade on Monday. We got our 100-day simple moving average, which we took out and closed above. We've got Friday's high, which was, I don't want to say that it was a look below the 10-day and fail, because it really wasn't even close to the 10-day. The 10-day was another 10 points above where the high of the day was. But this 10-day simple moving average is falling, and maybe it's going to be all the way down here around where Friday's high was. So we got to come on, if you want to be bullish and buying calls on Monday, or if you bought calls and are still holding them from Friday, you need to see Friday's high go down, and you know that that's probably also going to be a takeout of the 10-day simple moving average. And you can see we had a momentary takeout of it here during our bounce not last week, but the week before. Here was Monday's open, and then we sold off most of the week. But the previous week to that, September week 4, there was a breakout and 3 closes over the 10-day and the 50-day simple moving average, only to come back down and fail. So we got to get through the 10-day, got to get through that 20-day, which is now crossed down and lower than the 50-day is, and then through the 50-day again, and then we're home free. We're back to an all-time high. But if all we do is come up to Friday's high and maybe look above it and fail, which means that we're just maybe taking a look above the 10-day and fail, then we're going to continue to sell off, and maybe we're not even going to hold the October low that we set on Friday. I would say that if we come in and just dip a little and hold the 100-day simple moving average, that is a buy point for calls. If we come in and rally and fail against Friday's high, or only take a little look above it and fail with the 10-day simple moving average, that's a place to buy puts. If we come in with a gap up open on Monday and break out over the 10-day, that's obviously a long point, because we're rallying all the way up here towards the 20-day and the 50-day simple moving average. Okay, I hope that all makes sense. If it doesn't, you can always direct message me. I'm around in the morning tomorrow. I'll probably be able to post some charts right after the open, but then I got to head to work after that. Okay, let's take a look at the options and then end this video before it gets too ridiculously long for you. You've got to be using the October 8th expiration. That's Friday's expiration, and they are a little expensive right now because they're factoring in the non-farm payrolls report. Volume standing out here at the 42.50 strike, but they were above the $11 window. I'm guessing that, since we closed Friday 20 points off of the high of the day, I bet these got down to the $11 window during the high of the day on Friday. So that's where I would start looking, is at the 42.50s. And if your $11 window, if there's enough decay over the weekend that the $11 window is now up at the 42.75s, all the better. You want to, always get in at the highest strike you can afford to get in at. Over on calls, these are like ridiculously priced, $19 for these 4400s. But if you're gonna buy the breakout of the 10-day simple moving average, you probably could go all the way up to these 44.50s. Then I would rather be like maybe in the I would rather be below 44.50, maybe down here at the $8 window where these 44.30s and 35s are. But just look at least for your $8 window to get in on the calls. It's early in the week. You should be paying $8 and $11 windows. As we get into around Wednesday, then you can start looking at $5 windows there. But to start the week, I don't like to play the cheap seats. I like to get in as low of a strike as I'm willing to pay up for. Okay, that's it. I hope this video helped you out and gave you a good idea of where we're going. As always, good luck and good trading.